Almost every single trader has heard of the breakout strategy, and if you followed me for any amount of time, you know that I mainly trade breakouts. But no matter who you ask, they'll tell you that 90+% of breakouts fail in the markets, and it's not an effective strategy. Believe it or not, this is actually true. There are thousands of breakouts that occur almost every single day, and yes, 90 to 95% of those actually fail and they never end up breaking out. This is not the result of the breakout strategy not being a viable strategy that you can make money off of, but rather it's because you are focusing on low quality breakout setups. Yes, 95% of breakouts, probably even more, fail in the markets, but we as traders need to select the highest quality of breakouts in order to profit off them and see them actually continue in our favor. Trading breakouts and breakdowns are actually my favorite trading strategy. And in this video, I'm going to break down exactly what I look for when trying to identify high quality breakouts versus low quality breakouts. We're going to cover the exact criteria that you need to look for that is identifiable. So next time you're eyeing a potential breakout setup, you could have a list and you'll say, okay, does this setup, does this trading strategy that I'm looking at on the charts, does it fit all of that criteria that I have for the breakout? This is truly one of the most powerful strategies if you know how to trade it correctly. And by the end of this video, you will know how to trade it correctly. Before we start the video, make sure you register for my free live trading class this Thursday at 6 p.m. Eastern. The time might be different depending on when I made this video, but right now it's Thursday, 6 p.m. Eastern. I'm going to talk about how I got started with trading, how I learned, how you're going to get started, and a step-by-step framework on how to pick a winning trade. The class is live, and I'm also going to be answering questions at the end, so make sure you stay until the end of the class. You can register for the class in the description of this video. Well, let's not waste any more time, and let's get straight into learning how to trade the breakout. Before we get into the presentation for the breakout strategy, I want to talk about a few things. And if you haven't watched my recent YouTube video on the only two strategies that I trade in the markets, I highly recommend that you watch that video first before you proceed with this one, because it's going to give you a lot of insight and background information that you need to know about trading the breakout. But even if you haven't watched it, I'm going to do a quick little recap. So if you guys have followed me for quite some time, you know that I trade mainly correction strategies. So what is a correction? And this is a price correction specifically. So in the markets, prices can never just infinitely move higher or infinitely move lower. After a really large rally or move up or really large sell-off, you're going to have some sort of price correction take place. And these price corrections can provide us excellent opportunities to enter into that trade, enter into that stock, crypto, or Forex, and ride the trend either to the upside or to the downside. And there are two different ways that prices can correct. And as a result, there are only really two strategies that exist in the markets, okay? So let's start with the first type of correction that can occur. So after you get a really large rally in the markets, what you could see is a correction through price. This is a correction in the form of a pullback where you'll get a pullback, you'll get kind of a dip before it continues higher. And our goal, of course, as traders is to get in right here. Now, this is called a buy setup, and we're not going to be discussing this strategy today. Today, we're going to be discussing the breakout. So let me go ahead and draw the breakout. So the other type of correction strategy that could occur is where you get a large move up and then you get a consolidation before you get another move higher. And this is a breakout. This is where you get a large move up and then prices essentially stay at one price area, for some period of time before you get that breakout. And let me go ahead and circle the breakout. Before you get this breakout here, and then prices will continue higher. These are the only two strategies that exist in the markets. And this is a really simplistic way of looking at it. Of course, there's a lot of nuances, a lot of details that you need to understand, and that's what we're going to be covering today. But these are essentially the only two strategies that I trade. I trade retracement patterns. These are kind of pullback patterns. I call them buy setups, or I trade breakouts. And what I'm essentially doing is, number one, identifying the trend, right? Let's say we're in an uptrend on multiple time frames. That stock, that crypto, whatever you're looking at, is uptrending. And I look for retracements or breakouts within that uptrend. I know the direction is higher, and then I find opportunities to enter into that trend and ride it higher, essentially, okay? But these are the only two correction strategies that exist, and these are the only two strategies that I really trade. I also trade reversals, but I don't want to cover that today. We're going to be talking about that a different day. And today we're going to be mastering how to trade the breakout pattern, and we're going to be looking at all of the nuances, all of the small little details, all of the criteria that you need to know when you're trying to identify a high quality breakout opportunity. And yeah, I would highly suggest having a notebook in front of you, because we're about to hop into the presentation. It's going to be detailed, and I'm going to show you exactly what to look for. So let's not waste any time. Let's start with the breakout. So the breakout, like I said, this is a fundamental strategy that I trade, and it's honestly probably my favorite strategy in the markets. I've made the most amount of money from trading the breakout and the breakdown. So let's get into it. We already discussed that this is a price correction strategy where price is correcting through time. And the way that I want to describe this is we get a move up, and then we get a consolidation where prices are basically like not moving. They're in one area and they're not moving above or below that area. And the way that I like to think of it is, imagine you just ran a marathon, right? So you ran a marathon, 26 miles. Are you going to be able to immediately run another marathon? Are you going to immediately be able to continue running? Probably not. You're going to be tired. You're going to be exhausted. You're going to need time to rest, to hydrate yourself, to get some sleep, get some food, do some stretching, right? You need time to rehabilitate yourself, to rest up before you're able to run another marathon. And the markets work the same exact way. If you have a huge move up in the markets and a huge rally, well, the markets are going to get exhausted. The markets are going to need time to correct, to rest before they're able to, once again, continue in that direction. So I think that's a really, really great analogy for the markets. And our goal is to give the markets the opportunity to rest. And once they're finished resting or correcting, after exhaustion, after they've ran, it's had a huge rally or move up or move down, whatever, our job is to catch the breakout when it's done correcting and it's ready to move up again, right? And we're going to be timing our entry with the break of resistance. We're going to see that in a second. And by the way, this works for stocks, it works for crypto, for Forex, it can work for options if you know how to implement it correctly. Futures, it doesn't matter what you're trading, you're going to be able to use the breakout to your advantage and use everything that I'm talking about today. And yeah, this is a fundamental strategy that most traders perform, but a very small percentage of traders actually make money from this because, like I said, 95% of breakouts fail. Not even just breakouts, like we talked about the buy setup, which is the pullback setup. 95% of all retracements, all breakouts, probably like 99% actually, don't work. Because, and there's thousands of them that occur every single day. It's because only the highest quality ones are the ones that have a much higher likelihood of working in your favor. All right, now let's continue. So understanding the breakout, we already know that price corrects through a retracement or a base. A consolidation or a base, whenever I say that word, right, it's a base breakout. A base is a consolidation. It's a period of time where a stock or crypto is trading in a particular price range. It's not moving above that range. It's not moving below that range, right? So we get the move up. We're trading in this range for a while, breakout. We're trading in this range for a while, breakout, right? We're not like pulling back or moving up. We're staying in this range. Okay, that's very important. And within bullish uptrends, prices, like if you see a uptrend on multiple time frames, what you're going to notice is that prices tend to consolidate or base after a rally. This is one of the ways it corrects. So you're going to see this quite often, and it's going to present us very interesting opportunities to make money. Remember, A base at the highs of a rally is always inherently bullish. It's always indicative of strength, okay? I see a lot of traders who after a rally and then you get a consolidation and it's an uptrend, right? On multiple time frames, everything is screaming bullish about that trade and they'll short it. They'll short a consolidation that is at the highs. That you should never be doing that. That should just be like a rule. I'm not saying it's never going to work. Obviously, there's going to be instances where you're going to short a consolidation at the highs and it's going to fall apart and it's going to work on you, and you're going to make money off of it. But guys, generally speaking, have this as a rule in your trading. If you see a consolidation at the highs, you should always be looking to play long, not short. And of course, our goal is to catch the moment price breaks out. We want to catch the moment price is finished correcting. And of course, make money on this move higher and of course, this move higher. That is the goal here, okay? It's a very simple strategy. You're gonna notice that after you watch some of my videos, if you've been to my free class, which is on Thursday, hopefully you've already registered for it, you're gonna notice that everything that I do is rather simple, right? Like all my analysis, all my strategies, it's very simple. It's not easy, but it's simple. It's very simple to understand. And that's the way that I think trading should be. And the breakout is a very simple strategy, which makes it really easy for a lot of you to learn. Obviously, implementing it, applying all this information to make money is not easy. That's a bit difficult, but the actual strategy itself is pretty simple. So this is kind of what it looks like. You get a rally and then you get a consolidation, right? Notice how it's trading within this particular price range between these two lines, right? We're not moving up or below this price range, right? Now, the highs of this price range is going to act like an area of resistance. And the reason that is because during this consolidation, every time it hits the highs of the base, it tends to, drop back in, right? Like these tails right here, they all symbolize highs of that time period. Like if this is a 1 minute, if this is a 1 minute chart, these are 1 minute candles. These are all 1 minute highs. If this is a 5 minute candlestick chart, these are the 5 minute highs, right? But the highs of the consolidation, the highs of the base is going to act as a resistance area. The lows of the base, right, like these tails, the lows of it is going to act as a support area, right? So just remember, the top of the base is going to act like as a resistance area. Lows of the base is going to act as a support area. That's really important once we understand our entries and our stop losses. Just keep that in mind, okay? So let's get right into it, actually, with the entries and stop loss. So knowing that we have a resistance area directly above the base, we want to be timing our entry with the break of that resistance, with the break of the highs of the base. So whenever you have a consolidation and you're trading a breakout, your entry is going to go over the highs of that base, right? So you find the highest point, which is right here on that consolidation, you would put your entry above it. You always want to place your entry a couple cents or a little bit above the highs of the base. It's going to depend on like the price of the security you're trading. Like if it's like a $400 stock, then maybe place it 50 cents above the highs of the consolidation, right? It's going to be relative to the price of the stock that you're trading. But always put your entry slightly above the highs of the consolidation. We want to see it actually break through the resistance. We don't want to get tagged. We don't want it like come hit the highs, right? Barely hit the entry. Now you're in the trade and it just comes back in. You want to see a clear break, a breakout of this consolidation. So place your entry a couple cents or a little bit above the highs of the base, okay? That's where it's breaking resistance. That's what you're getting in. Stop loss, it's the same idea. You're placing your stop loss below the lows of the consolidation because that's a support area. So we always want to be placing our stop losses in a location where it invalidates the trade, right? So where we get into it, let's say hits our entry, we want our stop loss in a location where, okay, if it hits that price, the trade is no good anymore. The trade is invalidated, like that, there's no setup anymore. So, and the obvious place to put it is below the consolidation, right? If we break out and this comes back in and breaks the lows of the base, the trade's over. There is no trade anymore, right? And that's exactly where we're placing our stop loss. And same thing, place it a few cents below the lows of this base. So like, let's say this is the lowest price of this consolidation, place your stop loss a little bit below it. Don't place it directly below it, because a lot of times you might get shaken out where prices will like just hit your stop loss and then they'll immediately move back up, right? You don't want to do that. You want to make sure that, okay, hit your stop loss, the trade is officially invalidated, okay? Your target is the next resistance area, right? So the entry is above the highs because that's when price is breaking resistance. We talked about that. We're timing our entry with the break of resistance. We talked about that. Perfect. And of course, yep, we're placing the stop loss below the lows because of the support. We just talked about that as well. Hopefully this is making sense. Entry above the base, stop loss below. Very simple. This is a very simple entry and stop loss framework. And this should give you, a very clear idea, or not even clear idea, it's going to make it way easier for you. So when you identify a breakout, you don't have to be guessing, where's my entry? Where am I getting in? Where am I placing my stop loss? It's instant. You see a breakout, entry above the base, stop loss below it. By making the entry and stop loss very easy to identify and understand, it makes risk management easier to perform, okay? And we're going to get into that a little bit. Criteria number 2, very important. We want to see the 20 period simple moving average under price and trending higher. And we want to see prices, the consolidation, the base, go into the rising 20 period moving average. We're going to look at examples of this as well if you're finding it hard to understand. I think I'm going to make another video talking about how to use the 20 MA, but the 20 MA is, in my opinion, the most powerful trading tool in existence. It's also the simplest. It's in the name, 20 period simple moving average. I think a lot of people don't use it, or they kind of brush it off as like, I don't need this indicator, because it's so simple. And people tend to try to overcomplicate things, and they think that using fancy indicators is going to improve their trading. It's not true. Less is more in trading, as is in life as well. Less is usually more. So in terms of what the moving average is, it is basically the average price of the last X amount of days represented as a line. You really don't need to know the details of what it is or how it's calculated to make money off of it. You don't need to know that. Just understand it's a line that we use in our trading. It is a game changer for identifying trends, and we use it for trading the breakout. So usually you'll have a move stem from the 20 MA right here. You get the move higher, and then you consolidate, you base into the rising 20 period moving average. And this is precisely where you want to be timing your entry into the trade. We could use the 20 period moving average to gauge whether a price correction has finished or not. So for example, let's say you get a move up and you only consolidate into like this point right here. Like let's say these candlesticks don't exist and this is where the base is at. This is where it finished. We're at this point, we'd be pretty far away from the 20 period moving average. And as a result, we'd be what's known as extended, right? Where price hasn't finished correcting fully. And as a result, this breakout is much more likely to fail. We want to be really entering into breakouts when price is close to the 20 period moving average, that when it's rising under price and trending higher, okay? And we want to be checking multiple time frames to make sure that it's rising under price, trending higher, and that prices are near it when you're looking to enter in as a breakout, okay? And yeah, so refer to the 20 MA class. I'm probably going to make, this is actually some of the slides from my trading university, minus a few, but so that's why it says this, but I'm probably going to make another video like completely going in depth on the 20 period moving average for you guys. All right, let's continue though. Oh, okay, so perfect. I actually even pointed it out here. At this point right here, guys, after this rally, prices are extended from the 20 MA. What do I mean by extended? There's distance between price and the 20, right? You could see there's distance, right? We're not near prices like or near the 20 like here. There's distance. And by basing into the 20 period moving average, by consolidating into the 20, this is where the correction is occurring. And this is where we can identify whether the correction has finished or not. We never know for sure, There isn't anything in trading that is 100% we know the correction has finished. But by using the 20, we could be a lot more confident that the correction has finished. We're ready to break out and continue higher. And you want to be timing your entry when prices have based into the rising 20. And of course, your entry is over the consolidation. Perfect. Let's continue. Criteria number 3. This is volume. Now, I don't want to go too much into volume because that's kind of its own rabbit hole. A lot of traders tend to, make generalizations about volume that don't exist. They'll be like, oh, there's low volume here. This means this, and that. Not necessarily true. Or they'll say, oh, there's high volume on this stock. That means there's a lot of interest. That means it's bound to go higher. Not necessarily true. Just because you have high volume doesn't necessarily mean prices are going to go up. Just because you have low volume doesn't mean prices are going to go down. So lots of traders, they make up things in their mind about volume. Volume, at the end of the day, is most commonly used. I mean, I only use it for 2 things: breakouts, which we're about to learn, and reversals. And to be honest, it's so much more powerful for reversals. I barely look at volume when it comes to breakouts. I do, but I have it as criteria number 3, but it is not a make it or break it. This is kind of like a amplifier, right? It helps the trade. It's not completely essential, okay? But the one thing I will say is that during the actual phase of consolidation, while it's basing, we want to see volume taper off. We want to see low volume, okay, during the consolidation. When you have huge volume spikes during the base or during the consolidation, the likelihood that breakout will actually work is lower, okay? And actually, I will say this is actually quite important. I will say this. I do look for this. Thinking about it now, in my experience, I definitely look for this. I wouldn't say it's the most important thing, but it is definitely, definitely make sure you know this. So we want to see low volume during the consolidation, and then on the actual breakout, we want to see what's known as igniting volume, right? So you can see this is called continuation volume. This is another concept I talk about in my university. I haven't really talked about it on YouTube yet. I'll probably make more videos about it in the future. But so notice how on the rally, we have pretty nice volume. During the consolidation, the volume starts to drop off, taper off, and then you get igniting volume during the breakout. This is essentially what you want to see. Low volume during the consolidation, and then igniting volume on the breakout. Make sure when the breakout happens and you get igniting volume, make sure you actually get follow through. And I think I have a slide on this later, but if you have a huge volume spike without a breakout, that is a red flag, okay? I think I have a slide on it later in this presentation, but if I don't, then I'll circle back to it. But yeah, if you get a large spike in volume during a consolidation and there's no breakout, red flag, big red flag that breakout's not gonna work, all right? Okay, let's continue here. So the next thing we have is what I call kind of like a secondary entry. So we have the initial breakout, or I'm sorry, we have the initial move up, then we have the consolidation into the rising 20 period moving average, and then we get the breakout, our entries right here. And what you'll see a lot of times, I think a lot of traders actually look for this. They'll pass on this breakout opportunity. They'll be like, you know what? I'm not going to trade this initial breakout. What I'm going to do is let it break out, have it retest, right? Have it pull back, retest the highs here, and then they'll trade this pullback setup, this buy setup, this retracement pattern, and trade it higher. This is very doable. This is valid. I think it's, I've done it personally, but the problem with this is that you're not always going to get a pullback here. You don't want to miss out on a potentially really solid breakout opportunity waiting for this, secondary entry, waiting for this pullback to occur. You might miss out on this really nice breakout by waiting for this, and this pullback might never happen, right? And this is a good example where this prior resistance area on the breakout is now becoming support for the pullback, right? It pulled back into the prior resistance, which is now support, right, with this line, and of course you have the rising 20. So this is an option of what you could do. You could pass on the breakout, wait for a pullback, okay? So yeah, it's called a secondary breakout or a buy setup. It does not always occur. prices can continue to break out without providing a secondary entry. And of course, your stop loss are under the lows of the pullback. So with this case, your stop, like if this was to happen, your stop loss would go under the lows of this pullback. All right. Just wanted to throw it out there and give you that option. Here are a couple of examples of that where you get a move up, we get a really long consolidation, and notice how the 20 period moving average, which is this blue line, how it's flat, flat, flat. Right, notice right here how it's starting to curl higher. Very, very, it's very subtle, but starting to curl higher. That's when we get the initial breakout. Then we get that pullback, right? So remember, initial breakout, pullback. That's what happened here. We got the initial breakout. The entry would be over this red line. Pullback, we got the rising 20, and really nice move up. So if you didn't like this breakout, if you were looking at this and you're like, yeah, this isn't for me, it's sideways, it's not really all that clean, you don't like it, okay, no problem. You pass on the breakout, and then you capture it on this pullback, which is kind of like a secondary entry into the trade. Let's talk about criteria number 4, and this is when you have a consolidation at a prior resistance area. And we kind of talked about this already. Whenever you have a consolidation at a prior high or a consolidation at the highs of a rally, that is always inherently bullish. And just like that, whenever you have let's talk about criteria number 4. Whenever you have a consolidation or a base at a previous resistance area and at the highs of that resistance area, that is always going to be inherently bullish. We already kind of talked about this. Whenever you have a consolidation or a base at the highs of a rally, you should be looking to play long. That is showing strength. You don't want to be shorting when you're basing at the highs of a rally. And similarly, you don't really want to be shorting if you're consolidating at the highs of a resistance area, or rather a previous resistance area. So for you, in order to determine the previous resistance area, what you need to do is look to the left on your charts, go to the larger time frames, and find a previous resistance area, find a previous reference point. So if you're on the 15-minute chart, go to the hourly chart, go to the daily chart, try to find a previous resistance area and see, where is that resistance area compared to where the consolidation is that you're looking at. So if you're seeing that we're consolidating literally at the previous all-time highs, that is extremely bullish. That is not something you want to short. A lot of traders, they'll just blindly short at resistance, thinking that's a strategy. It's not. Think about it. A resistance area is an area where we've seen selling in the past. That's where an area where sellers have stepped up to the plate and brought prices lower. So if this is the prior resistance area, sellers stepped up to the plate, brought prices lower. If you begin to move up and then begin to base bullishly and consolidate at this previous area where sellers have been known to come in and bring prices lower, well, that's going to be bullish because sellers aren't bringing prices lower right now. We're consolidating there. So that is always going to be bullish. And you want to make sure it's at the highs of this resistance area. So what I mean by that is, like, let's say this consolidation was a little bit lower. Let's say this consolidation was happening like right here, right? Lower than this area. It was happening right here, let's say. Well, in that case, I probably wouldn't take the trade because in that case, you're buying into a resistance area, right? Where you still have this resistance above here and you're buying the breakout. Well, this breakout might not work all that well because you have this resistance area directly above. You want to make sure it clears all resistance, right? You want to make sure your entry is above this consolidation, but also make sure it's above the previous resistance area. Okay, so it really breaks out of that resistance and then it has room to run to the upside. So if your consolidation is like down here, right, and you're seeing to the left, you have a resistance area directly above, you want to be wary of that setup. You don't want to be buying into resistance. You want to be buying when it's clearing resistance. Okay, hopefully this makes sense. And another thing that I want to emphasize is that just because you have a consolidation at a previous resistance area, that doesn't necessarily mean you should definitely trade that breakout. What you need to do is combine all of these criteria to make a powerful trading opportunity, a powerful trading setup. You should be considering all criteria, not just one. That's what makes a powerful setup, when you have several different criteria, several of these, things that we're looking for, when they all align together, that's what creates a high probability setup. Okay, and that applies for all the criteria. Look for multiple criteria to be in sync. Okay, let's continue. Let's just look at some examples. So let's just start with the left here. Actually, first and foremost, before even that, we're going to start with the 20-period moving average. This blue line, it is under price, trending higher, curling up. The candlesticks are above. It looks great. We start to break out here, right? We form a high. We pull back right into the 20-period moving average. This is a retracement setup. We're not really going to talk about that right now. We're talking about the breakout, but this is a retracement setup right to the 20. We rally, and then we consolidate. We're consolidating at this previous high, right? This is a resistance area because it created a high. We pulled back in. This is resistance now. We're consolidating. We're basing. We have a very tight base at this previous high. That's exactly what I mean by consolidation at the prior resistance, okay? We base directly into the 20-period moving average. Boom, we break out. Not only that, we have very low volume during this consolidation, right? We see we have an igniting volume bar on this move up, then it kind of tapers off, and we have very low volume during this base. It's exactly what we want to look for. And then we get an igniting volume spike as soon as we get the breakout. Continue higher. Once again, right here, we have a retracement pattern right into the 20-period moving average. Then we begin to move up. So as you can see, this is kind of combining all of the criteria that we already talked about into this one setup. Consolidation at the prior resistance, great. Low volume during the base, perfect. Tight base, we haven't talked about that yet, but we will. Rising 20, perfect. Entry would be directly above this consolidation. Stop loss would go below it. Picture perfect breakout opportunity. Let's look at another example. 20-period moving average, under price, trending higher. Looks great. We have low volume during the consolidation, tight base. It's not whippy. It's consolidating into the rising 20. And beautiful volume spike on the actual breakout. Beautiful. Entry goes above the base. Stop loss goes below the consolidation. An amazing, amazing move. Higher, picture perfect setup, really. Okay, and this is, again, combining all the criteria we already talked about. Next criteria, this one really isn't that important, but if you like to draw trend lines, then you could certainly look for consolidations that base into a trend line. For me personally, I just use the 20 MA as my trend line. Okay, I don't ever draw trend lines personally, ever. I never have, actually. But if you like to draw trend lines, then look for a consolidation into the trend line, basically. Okay, here's another great example where we consolidate. We don't have the igniting volume spike, but that's okay, right? Doesn't mean it's not going to work. Low volume right into the 20, really nice breakout. Let's see here. Here, this is a bit more of an interesting pattern where we kind of, this was actually a gap up on a stock. We pull in, we consolidate for a little bit, right? It's not a huge consolidation, and you could place your entry above the highs of this little consolidation, stop loss at the low of the day right here. And that worked really, really nicely. And in this case, our first target would be this previous high, but we actually surpassed that. Really, really nice breakout opportunity. So you don't need a really long base like this. Even if you get 1, 2, 3, 4, 5 candlesticks basing, and this is the 5-minute chart. So you got to remember that's five 5-minute candles. That's 25 1-minute candles, right? Basing here, and then we get the breakout. Really nice. Same thing here. We move up, we kind of retrace a little bit, and then we consolidate into the rising 20. We don't have the volume criteria, honestly, but doesn't matter. Worked really, really well. But we do have a nice base, rising 20-period moving average. We're not basing at a prior high, so we do have this high here. That's the only thing that's kind of wrong with it, right? Because if we move up, this would be our first target. But it actually moved up and then actually retraced to this resistance area, now becoming support. This is called minor support, where you can see this is the first resistance area. The breakout, we actually went right through it. We pulled back into this area of resistance, right? If you draw a line, you see this area of resistance is perfectly synced, and now it's acting as support for this pullback. And again, that worked as well. Rising 20, beautiful. Another really great example. We move up, retrace a bit, we consolidate. In this case, we're kind of like consolidating upward. And we're basically like, when we do break out, we're actually breaking out of this resistance area as well, this high. So not only are we breaking out of this base, we're breaking out of this high, which is really nice, right into the 20 period moving average. Beautiful setup, okay? Here's another couple of examples. This one's not as clean, but still consolidation's a bit sloppy. We break out, get a couple of retracement setups, nice 20 period moving average, okay? Again, couple more examples. In this case, I would say this is the real breakout. We move up, consolidate, break out, we pull back. This is kind of like that secondary breakout that I talked about, secondary opportunity to get into the trade, right into the rising 20 period moving average. By the way, guys, you guys could see, like in this case, we didn't base directly into the 20. As long as the 20 period moving average is under price trending higher, you're good to go. Like I'm sure maybe on a lower time frame, this probably based into the 20 period moving average on the lower time frame. Another good point is check multiple time frames, and that's going to give you really good perspective on what's going on. Okay, always important to check multiple time frames. Check all the criteria that we talked about today. Check those criteria on multiple time frames. And once you get it, let's say it's aligned on multiple time frames as well, all the criteria that we talked about, that's what it further enhances the breakout. Okay, and really nice pullback here into that. This was a resistance before, now it's becoming support here. Boom, nice breakout. Again, we move up, consolidate, breakout. You guys get the idea, okay? We have even more examples. In this case, this would be the breakout. We move up, consolidate, breakout. This was a gap, so this stock had an overnight change in price. That's why the 20 period moving average took time to catch up, but really nice breakout opportunity. This was in the morning. Entry would go above the base, stop loss below the base. And this pullback, this was a nice retracement setup. Nice pullback pattern, buying the dip right into the 20 period moving average, and we moved up as well. Okay, another example, and this is actually to the downside. We move up, or I'm sorry, we move down. We kind of consolidate here. We get a nice topping tail here. If you guys haven't seen my candlesticks video, make sure you watch that. Whenever you have a topping tail, this suggests that price, like the buyers attempted to bring prices higher, and then they were slammed by the sellers right back down, right? So a topping tail suggests prices attempted to move up, and then they were rejected by the sellers. I really like seeing this, especially for a breakdown lower if you're shorting it, right? So we attempted to move up, failed, continued to consolidate, nice breakdown lower, okay? Volume, yeah, the volume criteria wasn't there. That's what I meant. Like a lot of times you're gonna get good quality breakouts and you might not get the full volume criteria. It also wasn't directly into the 20. That's because this was a gap down. It took time for the 20 period moving average to kind of catch up to price. Another great example, we moved down, consolidate for a while, entry below the consolidation, stop loss above it, nice breakdown lower. Really nice setup. I think this was a setup that made me, I think $500. Was this plug? I can't remember which trade this was. It was probably plug. But yeah, same thing here. We move down, consolidate, breakdown. We consolidate right into the 20, breakdown again. And you guys get the idea. It's really not all that difficult. Here's a really nice example where you get a move lower, we retrace, then we consolidate close to the 20 period moving average. This is to the downside, and we get the breakdown lower, right? Really nice example. We do kind of have tapered off volume. Volume kind of dropped. But yeah, really great example. And it actually reached, this would be the target. That this prior support, this prior low would be target. That's exactly where we reached. And it actually began to consolidate again. This is what I mean by consolidation at support. This is a support area. Now we're consolidating here. Unfortunately, this was like at the end of the day, this was at like 3:55 p.m. Eastern, which is when the stock market closes. The market closes at 4. So it actually ended up closing at the support. But if this continued to base, like let's say this occurred earlier in the day, and this continued to base at this prior support, I'd be looking to short it again. And that'd be a really nice consolidation at the prior support. I'll wait for the 20 period moving average to catch up, and we trade the breakdown, we short it under the base. Really nice. Here's another opportunity where here's the consolidation, nice tight base, and we get the really nice breakdown. You could see the 20 period moving average starting to curl like over price, which is what you want to see. We weren't basing at the prior support, so this would have been the first target, but we exceeded that clearly. Really, really nice setup here as well. Nice breakdown, okay? Criteria number 6, guys. The way that the consolidation is formed makes a significant difference on the quality of the breakout. So what we always want to see are clean and tightly ranged consolidations. We don't want to see sloppy consolidations, okay? We don't want to see a lot of tails. We don't want to see a lot of candlesticks moving up and down. We want it to be very clean. We want it to be a tight base. We don't want a sloppy base. So the tighter the base, that means the tighter the stop loss. That means the better the reward to risk. So you may recall earlier when we were looking at an example where I literally labeled it tight base. We can actually just go back to it. Or here's a really good example. This is a super tight base. You could see like there's not that many tails. There's one tail here, but it's a minor one. Not that many tails going up and down. Really, really tight base here. Let's find another example of like a really, really nice base. This is a really tight base. It's not sloppy moving up and down. And this would be an example of a sloppy base. You see how it's green bar, red bar, green, red, green, red, green, red. It's like Christmas lights. You don't want to see that. You want to see a tight consolidation. Here, super tight consolidation. Another example, I think here. This is literally the epitome of a tight base. Super tight consolidation. This is as well. It's epitome of a tight base. It's not sloppy. It's not going all over the place. The tighter the consolidation, the better it is, okay? And let's go back. So for example, here, which is the better consolidation? Here we have a pretty tightly ranged consolidation at the highs. We move up, tightly ranged base. Here we move up and it's sloppy. It's up and down, up and down. You don't want to see this. You want to see number 1. Now, let's talk about why you want a tightly ranged consolidation in the first place. And it all comes down to reward to risk, okay? So let's say for both of these setups, our entry is $3. However, for this setup, since it's a tightly ranged base, it's not up and down, our stop loss is going to go under the lows of the base. So since it's tightly ranged, our stop loss is at 290. Since this one is all over the place, well, we're going to have a larger stop. This one's at 270, okay? So you guys could see that because this is sloppier, there's a bigger difference between the entry price and the stop loss price. Here, it's only a 10-cent difference. Here, it's a 30-cent difference because this is sloppier, right? So stop size is 10 cents. That's what I call it. It's the size of the stop. 10 cents, the size of the stop here is 30 cents, okay? So let's say we're risking $100 on both of these setups, $100. In order to figure out our lot size or how much we're buying for this trade, like how many shares, how many coins, you're going to be using this formula. It's going to be the risk divided by the stop size. So $100, which is just a random amount that I selected. That this is obviously going to change dependent on your risk, but let's say we're risking $100 on this trade. $100 divided by 10 cents. 10 cents is the $3 minus 290, which is the size of our stop. So risk divided by stop size equals lot size, okay? So $100 divided by 10 cents is 1,000 shares. What this means is if I buy 1,000 shares at $3 and it hits my stop loss at 290, I'm going to lose $100, which is my predetermined risk. For this, it's the exact same thing, $100. However, because the size of our stop is larger, it's 30 cents, not 10 cents, $100 divided by 30 cents is 333 shares. What this means is if you buy 333 shares at $3 and then it hits your stop loss at 270, you're going to lose $100, which is your predetermined risk. The point is, you're going to end up making much more off of this trade if it hits target because you're buying more shares. You have a larger lot size, but still maintaining the $100 risk. This setup is not any more risky than this setup, or this setup isn't more risky than this one. The risk is equivalent. The risk for both of these setups is $100, but what's changing is the amount of shares that you're buying because the size of your stop is changing. Because this is a tighter base, This is a sloppier base. As a result, if it hits target, let's say our target is identical as well, 330, we're profiting $300 off of this trade while only risking 100. For this one, we're only profiting 100 with a $100 risk because we have a larger stop, because this is a sloppier base. Hopefully this all makes sense. You may need to go back and rewatch this whole segment to really understand it, but the point is, the sloppier the base, the worse the reward to risk is. Okay, so that's why you want tighter bases, tight consolidations. You get a better reward to risk while you're still maintaining the same risk for both of these setups. Okay, okay, perfect. So hopefully that all makes sense. This is the important. And also, when it's sloppy, it's just less likely to work. When you have a tighter base, they're just, trust me, they're much more likely to actually work out in your favor. The next is we have a breakout and breakdown failures. So bullish base, so if you have, let's say, a base at the highs of the day, and it has a breakout failure, which is a topping tail, especially on high volume, that's indicative that a reversal to the downside may occur. We'll look at an example in a sec. If you have a bearish base, that means a consolidation to the downside that has a breakdown failure, which is a bottoming tail on high volume, that's indicative a reversal to the upside may occur. So this is a great way of predicting whether a base breakout will fail or not. So here's what I mean. So we get a move up and we consolidate. Let's say we attempt to break out, but then this leads to a topping tail. Remember, we talked about a topping tail. It suggests that the sellers took control of price. Sellers rejected prices from continuing higher. So we consolidate, we attempt to break out. This leads to a bottoming tail. Sellers have rejected it. You continue to base, especially if this happens on high volume. Like let's say you get a huge volume spike as well, and then the sellers reject it. It continues to consolidate. It could be indicative that you're going to get a reversal to the downside. Just like this is the opposite. You get a move lower, you consolidate. If you get a breakdown, right, where sellers brought prices lower, but then it leads to a bottoming tail, and you should know this if you watch my candlestick video, a bottoming tail suggests that the buyers rejected the sellers. So it's basing, attempts to break down, the buyers reject the sellers, ends up as a bottoming tail, especially if this happens on really high volume, and then you continue to consolidate. This could suggest a reversal to the upside. So if you get a breakout and then a failure on high volume, it can be indicative that a reversal will take place. If you get a breakdown on high volume and then a rejection, it can be indicative that a reversal to the upside could take place. All right. So these are the main criteria that I look for when identifying a high quality breakout opportunity versus a low quality breakout opportunity. So I suggest writing down all of these criteria, have it like on a notebook. So whenever you're looking at the charts, you're looking for potential trades or potential breakout opportunities, you could refer to it and have kind of like a checklist of, okay, does this breakout have this, this, and this? And of course, this is going to apply whether you're in the stock, crypto, or Forex markets. And I'm going to make other videos finding breakouts live, or maybe I'll do trade recaps where after I have a really good trading day where I traded a bunch of breakouts, I can do a recap of all of those breakout opportunities and go kind of step by step what I saw in them, which criteria met, or which criteria that breakout actually met. And yeah, and we'll go from there. So make sure you subscribe to watch the other videos. And this video is mostly about theory. We did look at a lot of examples, and I'm going to make other videos in the future going more in depth with the practical side of it. But I thought it was important to make a video about the breakout that's more about the theory, about the textbook qualities that you're looking for. So perfect. Hopefully you found a lot of value. And of course, if you did, make sure you subscribe. I think I said that already, but make sure you are a subscriber to this channel because I'm creating lots of great educational content for you guys. And of course, make sure you register for the free trading class this Thursday. I will see you guys there. You probably should have already registered after the beginning of the video, but if you haven't yet, here's a reminder. Make sure you register. We're going to be going over lots of amazing information in the free class. And at the end of the class, I'm going to be dropping a special gift for you guys. And of course, I'm going to give you the opportunity to ask me questions live, and I'll be answering questions live throughout the entire presentation, throughout the entire class. Perfect. Have a great day, and hopefully now you will be a master practitioner of the breakout.